So here we're going to pivot into Europe, and I think it's important to look at what is happening in the European theater as things continue to worsen in different levels. But we want to talk again also about the ECB fragmentation. And you might be thinking, what does that mean? What is fragmentation? So when you look at the European theater, so there's the European Union, obviously, and you have the Eurozone. But a lot of these countries share the euro. So even though they share the euro, they have their own debt. So think about the US in general. So, yes, each state has municipal debt and the municipalities in general, but there's a federal borrowing where when you look at the different countries, they can borrow separately, and that can put pressure on different pieces. So typically when you look at the US debt profile, we're talking about the federal borrowing. So we talk about the U.S. Treasuries, the U.S. T-bills, the U.S. bonds, the Treasury bonds. And so you're looking at it on a holistic level. When you look at Europe, you're looking at it separately. And that's creating what they're calling, obviously, fragmentation, which is when you're getting the yields shifting so extensively between, let's say, Italy versus Germany, or Greece versus Germany, where Germany is kind of the central point. That's your risk-free rate, and then you're going to have a spread off of that. So the fragmenting of it is this huge surge in the periphery, which the ECB is trying to slow. So if you think back to Milton Friedman, his whole thing has been that if you look at forcing these yield holds and by not allowing the currencies to adjust. So let's take an example. If you want to go on a vacation and the German Deutschmark is strengthening, it's going up, but Italy's in a little bit of a struggle, their economy is slowing, so the Italian currency is actually falling. So if you look at it, you're like, all right, well, I want to go on vacation, I want to go to Europe, but Germany's kind of expensive right now. Italy's pretty cheap. I'm getting some deals, so I'm going to go to Italy. And again, they're going to attract more. Now, that's just tourism. You can do the same on, I have to buy white goods. I want to buy some porcelain. Milan is going to be cheaper than Germany because of the exchange rate. And then you have kind of this natural balancing out. Again, all of these are extreme examples, but this is the general thesis of having the movement of their own currencies and their own debt. And if you were going to merge them together to have them have the same currency and debt, but instead there's fragmented on the debt side, creating this underlying conundrum, which was the problem that Milton Friedman was highlighting. It's either all or nothing, not a mixture of both, because that will create some of these problems, which are coming out again. They came out during the European financial crisis that started in 2011 and only got worse, but you're seeing those pressure points throughout. So all the while, the CPI year on year is at 8.1%, month on month 0.8%, CPI core 3.8%, construction output coming down, being negative in April. We think it's negative again in May and June. And then consumer confidence going in the wrong direction, which we had been saying, from negative 20.5 to negative 23.6, and moving further with the US. So when you start thinking about it, and obviously the UK, based on British exit, I'm sure unless you were living under a rock, you know that British exit was a thing. But it's important because the UK, Bank of England, has been raising rates. The ECB hasn't raised a rate yet. So I think it's 132 months now that we're in June, 132 months without a rate rise, where the Bank of England has been very steady, now taking it over 1%. And some of the bigger issues is real wages continue to go deeply negative, which is what they're trying to get after. And I know the UK is no longer in Europe, but it's important to look at this is a global issue, as we showed in the savings side. It's a global problem on the savings rate as well as real wages. So then when we start looking at the spread, this is the spread of what we're discussing when we look at the anti-fragmentation. So questions for the new ECB anti-fragmentation tool. So this is coming from Robin Brooks of IIF, who I think does a really good job of highlighting this. So let's say Italy goes into another political crisis like in 2018, and the spread on the 10-year BTPs over bonds rises. Will that be considered fragmentation of monetary policy transmission or justified rise in the risk premium? Because now you're starting to say, okay, well, what justifies fragmentation movements? Like, what is a fragmentation shift? What is driving that? And I think we're seeing some of these unknowns in terms of, well, what is the definition? So now the real 10-year U.S. Treasury yield is still very low, so we'll have to rise further to tighten U.S. financial conditions. Italian spreads are high beta, so if global real rates rise, Italy's spread will widen out given Italy's high debt. Is this fragmentation? So as we said in segment 2, the Fed's funds rate becomes so pivotal to where these shifts happen that if the Italian debt responds to the U.S. rise, can you say that's fragmentation? Like, what is fragmentation? What if if R isn't low anymore given rising geopolitical risk, debt rises due to COVID and supply disruptions? Isn't it natural for markets to punish countries with big debt overhangs if the rate goes up, and an incentive for these countries to bring debt down? So shouldn't you penalize anyone who's looking to borrow more? And again, this is when you start looking at the backdrop of Europe and the problems that come in with what is fragmentation, what is natural market moves, and what is fragmentation that will come in under this new policy tool. The Eurozone and German manufacturing inventories starting to creep higher. And again, showing that slowdown, that economic pressure. So as the economy slows, again, you're going to see that in terms of how are rates reflecting that. What are the underlying shifts? So will European and UK consumer sentiment next week follow the sharp drop in the US? The answer is yes, it did follow it. This is a bit old, but it's still not where the University of Michigan is, but it is in line with the consumer confidence number from the conference board. So that's why we look at all the different pieces, because it's all moving in the wrong direction. It's just at different paces depending on how and what they're looking at. In the meantime, inflation pressures rose again in Germany. The German PPI jumped by 33.6% in May. The highest increase ever since the start of the statistic was kept in 1949. Electricity prices rose by 90.4%. Especially high were the price increases for fertilizers and nitrogen compounds at 110.9%. So the white line is looking at month on month, which you can see is fluctuating, while when you smooth it out and look at the year on year, the pace is slowing. Remember, the rate of change is going to slow, but we're not getting deflation. And this is going to be an underlying driver of future inflation, which is why when you look at the German CPI versus the PPI, the CPI is at 7.9 and the PPI is at 33.6. So in which direction do you think this is going to naturally trend when we're looking at the underlying backdrop? But if this is happening in Germany, which is a net exporting country, which has a lower debt bubble versus Italy, well, shouldn't Italy rates rise without triggering that fragmentation? So again, these are the pressure points when you're looking at how Europe is going to handle this. German industrial operating margins have continued to fall. We see that coming down and again pulling that lower, with industrial wages again continuing to move, not so much negative, but just in a very fixed band, which is still going to be negative real rates because inflation is so just parabolic at this point that even if you get a little bit of a wage increase, real wages are still going to be deeply negative, which is going to be a bigger issue for the underlying consumer. Now, the other key piece, which we've talked about, is the cooling and energy inflation is going to be offset by a rise in food and core inflation. Remember, sticky inflation is going up. Flexible inflation, which is where energy would pivot, not to say that it's going to in the near term because of Freeport LNG, the shortage of natural gas, the issues that remain with Russia. But it's realistic when you look at it from the perspective of where are they going to replace it, with Germany being the largest entity impacted without Russian gas. I mean, 28% of their gas comes from Russia, and it's the largest. It's of Western Europe. It's the country with the largest impact by a country mile, which is the underlying issue. And now when you look at industrial production, again, as these costs go up, that's when we expect that production to continue to trend lower. Now, when we shift to the French National Assembly, you can see that Macron was hit with a fairly sizable defeat, given what seats he lost. And again, that's where we're going to get more of the pressure, because Le Pen, the one that gained the most, is against the helping Ukraine, and is also anti-European Union, which is going to create more strife and more struggle within and getting policies through on the French side, which is going to create, again, more pressure for the French economy. Now, the market is pricing for the ECB deposit rate by the end of 2022 continues to go up. As you can see, that the expectation is that 1.22%. And the question is, the market is essentially forcing them to raise rates, but they know that as they raise rates, construction output, all of these things which are just starting to roll over, are going to accelerate to the downside, but they've put themselves in a no-win situation, which is why we think that aspect is very likely. And this, when you look at service inflation, is set to rise further in Q3 when you start looking at those pressure points. And this is why, even if you do, say, for example, Russia leaves Ukraine, everybody makes nice, all of the natural gas turns back on, you still have service inflation. You still have inflation that's sitting there on so many pieces that, yes, you'd get the flexible coming down, but you would still get this massive problem on the base side. And that's what, when you start looking at these different pieces, and I think it's important to look at how aggressive inflation is going to be. It's from poor monetary policy that it spanned over decades. We're not looking at, yes, don't get me wrong, they just dumped money into the market for COVID, but you have to look at where this set up. And in the next segment, we're going to talk about the Bank of Japan and what they've done and how they ushered in that quantitative easing that became the mantra all throughout, and the problems that has created. And here, when you still have the nominal rates negative, which means that real rates are deeply negative in Europe, you're going to have more and more pressure and problems that we have yet to even see come out. And as they try to start to massage their way out of this, we're going to see them continue to hit hard and, again, drive down that economic growth. So that's what we have for you in this segment. In the next segment, we're going to go bigger into Asia with a large focus on the yield control curve and what is happening with the Bank of Japan.